In a quiet office somewhere, a hiring manager just opened a spreadsheet. No announcement, no meeting, just numbers. Revenue down, costs up, forecast uncertain. He scrolls, pauses, then deletes 3 rows. No headline will mention this, but this is how recessions actually begin. Not with panic, with small, invisible decisions. And right now, those decisions are happening everywhere. The strange part is, the world doesn't feel like it's in a recession. Stock markets are still breathing, restaurants are still full, airports are crowded. On the surface, everything looks fine, which is exactly what makes this moment dangerous. Because recessions don't start when everyone is afraid. They start when most people still feel comfortable. So let's talk about what's really happening. Why some economists quietly believe the next global recession hasn't just started, but has already been unfolding in slow motion. And why most people won't notice it until it's too late. It begins with a simple shift. For over a decade, money was cheap. After the 2008 financial crisis, central banks around the world made borrowing incredibly easy. Interest rates were pushed down, sometimes close to zero. The idea was simple. If money's cheap, people borrow more. If people borrow more, they spend more. And if they spend more, the economy grows. It worked. Companies expanded, startups exploded, asset prices, stocks, real estate, climbed higher and higher. But cheap money has a side effect. It hides risk. When borrowing is easy, bad ideas survive longer than they should. Weak businesses look strong, and debt quietly piles up in the background. Then something changed. Inflation. Suddenly, everything became more expensive. Food, fuel, rent, labor. And central banks had no choice. They raised interest rates fast. This is where the story shifts. Because when money stops being cheap, the entire system starts to tighten. Think of the global economy like a giant machine powered by debt. Households borrow to spend, businesses borrow to expand, governments borrow to function. Now imagine that the cost of that debt suddenly doubles. The machine doesn't stop instantly. It slows, quietly, relentlessly. Let's look at what that actually means. A company that once paid 2% interest on its loans is now paying 6 or 7%. That's not a small increase. That's a complete change in strategy. Hiring freezes, expansion plans get canceled, budgets shrink. And remember that hiring manager? He's not reacting to today. He's reacting to what the next 12 months might look like. This is how recessions build. Forward-looking fear. Now zoom out. Multiply that decision across thousands of companies, across multiple countries, across entire industries. You don't get a crash. You get a slow bleed. Here's the uncomfortable math. Global debt is now over $300 trillion. That's governments, corporations, households combined. When interest rates rise, the cost of servicing that debt explodes. Even a small percentage increase translates into trillions in extra payments. Money that could have been used for growth is now used just to stay afloat. And this is where things get fragile, because not everyone can afford to stay afloat. Some companies start missing payments, some households start cutting spending, some governments start facing pressure. Nothing dramatic, not yet, just small cracks. But cracks spread. Now here's where it gets interesting. While the real economy is slowing, financial markets often tell a different story. Stocks might go up, tech companies might report strong earnings, headlines might sound optimistic. It feels disconnected, almost absurd. How can things be slowing down while everything looks fine? Because markets are not the economy. Markets are expectations, and sometimes expectations are wrong, or delayed, or overly optimistic. There's a quiet irony here. The same system that created years of growth is now making it harder to see the slowdown. Liquidity is still floating around, big players are still positioning for the future, and short-term data can look stable even as long-term pressure builds. It's like watching a bridge hold steady while its supports slowly weaken underneath. Now let's talk about the global layer, because this isn't just one country. The world is deeply connected. If manufacturing slows in one region, exports drop in another. If consumers cut spending in one country, businesses elsewhere feel it. Trade slows, investment slows, confidence starts to slip. And confidence is everything. Once businesses and consumers start expecting a downturn, they behave differently. They spend less, hire less, risk less. And those decisions create the very slowdown they fear. It becomes self-reinforcing. This is why recessions feel sudden, not because they start suddenly, but because they become visible all at once. Now let's contrast the story we're told. Strong job market, resilient economy, soft landing. These phrases aren't lies, but they're incomplete, because they describe the present, not the direction. And recessions are about direction. A plane doesn't crash because it's low, it crashes because it's descending. Right now, many indicators are pointing down. Manufacturing activity in several major economies is contracting. Consumer savings in many regions are declining. Corporate margins are under pressure. Nothing catastrophic, just consistent. And consistency is what matters. So where does this lead? That depends on one thing: time. If high interest rates stay for longer, the pressure builds. More debt becomes expensive, more businesses adjust, more households pull back. Eventually, the slowdown becomes impossible to ignore. But if rates drop quickly, the system gets relief. Debt becomes manageable again, spending picks up. The cycle resets. This is the balancing act central banks are trying to manage. Too strict, and they trigger a deeper recession. Too loose, and inflation comes back. There's no perfect move, only trade-offs. And here's the part most people don't think about. Even if a recession is mild on paper, its impact is uneven. Some industries get hit hard, others barely notice. Some people lose jobs, others see new opportunities. Which makes it harder to recognize in real time. Because your personal experience might not match the global reality. You might feel fine while the system quietly shifts around you. And by the time it becomes obvious, most of the adjustment has already happened. That's the nature of these cycles. They don't announce themselves, they reveal themselves. Slowly, then suddenly. So when someone says the next global recession has already started, they don't mean there's a crash tomorrow. They mean the conditions are already in motion. The decisions are already being made. The pressure is already building. The machine is already slowing. You just can't fully see it yet. And maybe that's the real question. If a recession begins quietly, in spreadsheets, in budgets, in small decisions no one notices, at what point does it become real? When the data confirms it? When headlines say it? Or when it finally reaches you?